Well, how's it going, friends and family? My name is Zamos. Today, let's go ahead and talk about 16 stocks that just increased their dividend payouts. And at the end of the video, I'll be giving you my thoughts, opinions, and picks. I'm going to be completely transparent with you. I just got back from eating at a buffet. And dude, the food coma is just it's kicking in right now. I'm like, oh. So if any point in this video I start dozing off, you know why. It's not because of a medical issue. It's because, dude, I just ate literally like 7 plates worth of food. But anyways, going back to the video, as a reminder, on this YouTube channel, we like to invest into high quality companies that are here today and are here tomorrow. A business model that is resilient, and they have an economic moat that is so wide that their competitors, peers, and rivals, they can't get over that wall. And companies that have predictable growth in their numbers, aka the name of this channel. Is it a little too dark in here? Let me move this curtain. I'm not trying to lighten up the mood or get romantic or cute with you. It's just, I don't know if it's too dark. AKA the name of this channel. Dividend compounders with cheese. Now, between you and me, I really try to go out of my way and avoid investing into companies that are crappy, low quality. Because even though it's embarrassing to admit, I've been burned in the past by doing that, by investing into really crappy companies, hoping for a turnaround story that just never came. And I think one attribute that crappy companies have in common is that they have a dividend history that has cuts. So whenever the time and the going gets rough and the storm is a little too much and the thunders are too loud, they start cutting the dividend. All that to say, about once a month, I like to monitor the different companies that are listed in the stock market that increase their dividend payouts. That way, if I don't understand or know about one, I can do my homework and research to figure out whether or not I want them to be a part of my portfolio in the future, given the right price. So with that said, friends and family, company number 1 is going to be M&T Bank, ticker symbol MTB. And they're currently trading just shy of $200 a share. They're 1 year low. This is a metric that I like to use to screen for potential buys or sells or whatever. But the lowest price they reached in the past 1 year is $150. So when you think about it, at their current price point, they're up by 32% from that valley low price. And their current dividend yield is 3%. Now, this is the part that we all care about, okay? So their dividend payout is growing from $5.40 per fiscal year to now $6. And they just posted their earnings and they just absolutely smashed it out of the ballpark. If you don't know M&T Bank, it's a regional bank that's located in the East Coast of the US. And they do a little bit of everything: investment banking, equity research, retail banking, and the list goes on and on. And they bought back about $1.1 billion worth of their own stock, which is why their EPS was so freaking darn good. Case in point, if we pull them up on the screen right now, I'm using stockanalysis.com, by the way. I don't know if I've ever mentioned it, but if you look in my video description, I actually have a referral link where if you want to use Stock Analysis Pro, you get 10% off on top of whatever else discount they give you. So it's 10% on top of whatever else. But having said that, if we jump on over to their financials, take a look at their income statement. Right now, what are we working with? Their revenue was $8.9 billion. And if we scroll on down, take a look at their EPS, it is $15.44. If we take a look at what's going on and we zoom out to year 2015, we were working with $7.18. However, right now, it's $15.44. It effectively doubled in about 10 years. Reason being is that they decreased the amount of shares that are outstanding, meaning when you take the earnings per share, which is the bottom line per share, the profits per share, if there's less shares outstanding, then the EPS gets pumped up. Does that make sense? It's a good thing, but it's also accounting manipulation. And so when you take a look at their bottom line per share growth, it is 14.4% year over year. It used to be $14.64. Now it's $15.44. So because the bottom line per share grew by about 14%, that's why they were able to effectively increase their dividend payout by 11%. Because the dividend increase is a testimony to the business growing their bottom line. They play with each other. So what I'm trying to say is, if the profits for a company are not increasing and are not growing, then they're also not going to be able to afford that dividend to grow as well. The dividend payout ratio is effectively how much of their profits are used for the dividend payout. So if you have an 80% dividend payout ratio, then that means 80% of their earnings per share, which is the bottom line or the profits, of that 80% are used for the dividends, and you only have 20% left over to reinvest into the business, to do whatever you need to do to take care of your operations. And that's why, as a dividend growth investor, you do want to see that payout ratio be as low as possible. In the case for M&T Bank, and we take a look at their profile, it is a 34.9%. That is really good. They have 65% of their profits left over to do as they see fit. And I think that's pretty good. The last metric that I want to mention is for every $1,000 that you have invested into M&T Bank, the payout will be $30.04, which is basically the dividend yield played out. The next company that we're going to be taking a look at is Realty Income Corporation. I feel like in the dividend investing community, you either love them and you get it, or you hate them. There's no in between. There's no one who's kind of like neutral, or as they say, lukewarm. And prior to making this video, I reviewed their last earnings, which is basically their financial progress for the past 90 days. And I got to say this, their financial health as a REIT, it looked pretty good. Realty Income Corporation has a real estate portfolio for a whole bunch of different commercial clients. And they do a triple net lease, meaning the clients are responsible for maintaining the property that they have leased from Realty Income. So they're the ones that are paying the insurance, painting the walls, taking care of the sidewalks, the garden, and the upkeep of the building itself. For me personally, I'm not a real estate investor, but that makes a ton of sense for me. So I love their business model fundamentally on a high level. And going back to their earnings report, they increased their guidance for the rest of the year. A REIT. The real estate industry, some of them are doing hot depending on their market and portfolio, but for other REITs right now and real estate companies, they're struggling. But for Realty Income Corporation to be able to increase their guidance for the rest of the year, I think that's pretty good. And my favorite part of their earnings is that the leadership team increased the guidance for their AFFO as well, adjusted funds from operations. The AFFO to a REIT is basically the free cash flow to a normal company. Because for a REIT, you should never look at their free cash flow. It makes absolute zero sense to do that. And speaking of REITs, and what also makes them unique is they have to pay out at least 90% of their earnings, their bottom line, their profits per share out as dividends by law. Because of that, they get good tax treatment from the government. So when you see a high payout ratio for a REIT, it's not a big red flag. Instead, you should be looking at the AFFO payout ratio. Did you learn something new? But anyways, what's interesting about Realty Income Corporation, ticker symbol O, is that their dividend distribution is every single month. And the fact that they're able to increase their dividend payout means what also increased? Their earnings per share. So you're learning. I'm proud of you, man. Anyways, they're trading for $58 a share. The lowest price that they achieved in the past 1 year, talking about $50.71. So they're only up by 16% from their bottom price. And I think if we pull them up right here, we can take a look at it. So Realty Income Corporation, zoom out for the past 1 year. If you were able to snag them at a discount in January of 2025, you're probably a happy camper, because not only are you getting a juicy dividend, but you're also up in the green by a significant margin. However, if we zoom out for the past 5 years, Realty Income has been struggling. They're basically flat for the past 5 years, only taking into account their share price appreciation. But if you bake in those dividends as well, your total return, you would be in the green, you would be happy. But if you zoom out and look at their max history, it is by definition a dividend compounder with cheese. A 660% total return, just taking into account their share price right here, $58 going up. If we bake in the dividends as well, it's a much higher number. But having said all of that, I don't want to butter them up too much like an oven roasted turkey, because the dividend only grew by 2.2%. But I'm going to say this right now. Growth in the dividend is better than no growth. And what's crazy about Realty Income Corporation, here's a fun fact. When we take into account their dividend profile and how consistent and reliable their dividend payment is, right now I'm looking at, and you're looking at, their investor presentation. Basically, they post this every 3 months or 90 days so that you as potential investors, or if you are invested into them, you can know and you have line of sight and transparency into the business health. They've been paying a consecutive dividend for 661 months. Of which, when you break that down on a quarterly basis or every 3 months, they've been increasing that dividend payout for the past 111 quarters. So if you divide that by 4, then you can figure out the years. And I don't know about you, but I feel like Realty Income Corporation is just one of those dividend payers that a lot of investors, that's how they get introduced to the whole idea of dividend investing. The monthly dividend, the high dividend yield, and the fact that they're so stable and reliable. They're not sexy. They're not making anything AI or tech related. However, they own a portfolio of commercial real estate. They are here today and here tomorrow. A very resilient business model. The next one that we're going to be talking about is Federal Realty Investment Trust, ticker symbol FRT, currently trading for about $99.45. Their 1-year low was $80.65. So from that, they're up by 23%. Current dividend yield is 4.5%. And I believe their dividend payout is every quarter. So it's not every month like Realty Income. Yeah, every quarter or every 90 days. And their old dividend was $4.40. Now it's $4.52, a growth of 2.7%. So for every $1,000 invested into Federal Realty Investment Trust, you get paid $45.45. Now, if you don't know about Federal Realty Investment Trust, it's a real estate company with a good chunk of their portfolio serving shopping centers with an open courtyard. You know what I'm talking about? The ones where you can have like musicians playing, food stands, the open concept of shopping centers and outlets, kind of like Realty Income, but not really. And just like Realty Income, Federal Realty Investment Trust, they increased their guidance for the rest of the year. By the way, if you haven't already, you should check out my REIT industry breakdown video because both of them are featured and we go into more depth about their business model and their grade against the competition. By the way, I don't know if you're anything like me. I have a portfolio that's full of different high-quality dividend compounders with cheese, but having said that, I'm constantly on the hunt to look for new potential dividend compounders with cheese to add to the watch list and eventually into the portfolio. Like, I should be satisfied with what I have so far, but I don't know what it is. It's like maybe I'll be able to add one more hidden gem. I don't know if you can relate to me on that or not, but to accentuate the spirit of this video, I feel like one screening criteria that's really useful to figure out whether or not a company is going to be a dividend compounder with cheese is their dividend profile and dividend growth, because it tells you two things right off the bat. Number one, the company is profitable. You cannot afford a dividend if you are unprofitable. Yes, you might be able to get away with it for 1 quarter or maybe even 1 fiscal year, but to do it for 2 years or 3 years, you can't do that. You're gonna be burning through cash, and by tackling on way too many loans in order to finance that dividend, eventually you're gonna go belly up, meaning bankruptcy. So to be able to afford a dividend and to grow it, they're gonna be a profitable company because the dividends are paid from what? The bottom line per share. If that's not green and positive, you ain't gonna pay a dividend, sir. And yes, there are some crappy companies out there that pay a dividend that have no business doing so because they should be using all that money, retaining it in order to survive and try to make the company relevant again. I'm talking to you, Western Union. No business paying a dividend. They should be fixing the business model, but whatever. And then number two, it also tells you that their bottom line is improving. Because if the dividends are growing, then also their profits are growing. So that's an easy way for me to figure out whether or not I want to even research a company. If they fail the sniff and the smell and the taste test of their dividend profile, then I know it's just not worth my time. Now, depending on who you are and your shoe size, everybody has a different metric that they like to apply as a screener, right? Some people are all about debt. Some people are all about free cash flow. Some people are all about their relationship to AI. If they're not a part of the semiconductor chip space, they're like, I don't want anything to do with you. For me, as a dividend guy, I need you to be able to pay a dividend, because if you're not paying a dividend, you're going to have smoke and mirrors and you're going to be burning through cash to show me why your speculative narrative is worth my money invested into you, and I just don't want to play that game. Yes, there are some growth companies out here that are profitable, that do not pay a dividend, that are high quality. I can name a few off the top of my head, right? Like Carvana, Palantir, and even Amazon. But on the other hand, I can count dozens of quote-unquote growth companies that are unprofitable, burning through cash, are negative free cash flow, do not have a dividend profile, and they are the type of investments where their story and their future hype means more than their fundamentals and numbers. I'm more of a numbers, data, metrics kind of guy. So if you disagree with that, this video probably makes 0 sense to you. But anyways, moving on to the next company is going to be BP, also known as British Petroleum. Speaking of which, did you know that last night Tottenham played against Manchester City and they whooped their booty? I'm talking about a straight up whooping. First half to second half, my goodness gracious. We are back, friends and family. Can you take a look at the flag in the background? Coys! So if you pause this video, open up a new tab and look up the English Premier League table right now, Tottenham is number 1 out of 20 teams. I know it's too early in the season, but let me just enjoy that glory. Because last season, dude, we finished at the bottom of the table. We were number 17 out of 20. We almost got relegated. All right? And now we're number 1, baby. We're back. Woo! But anyways, speaking of BP, they're one of the big oil and gas players alongside with like Exxon, Chevron, Shell, and they do a little bit of everything in the energy sector. They're upstream, midstream, and they're making that very slow and eventual pivot into clean energy like wind and hydrogen because the oil business model, their days are pretty limited. I just made a video talking about the sectors and industries that are not buy and hold forever. That video is absolutely controversial. Give it a watch if you have not already. I give more elegant thoughts on the oil and gas field in that video. But anyways, $34.74. Dividend yield is pretty juicy. But what I want to know is this sustainable? So let's look up BP right here. Jump on over to their dividend profile. Their payout ratio, friends and family, 5,569%. So what's going on here? So if we jump on over here, their annual dividend payout right now is $1.98. And if we jump on over to their financials, look at their income statement and scroll on down to the EPS, which is the what? The profits per share. Right now it's 3 pennies per share. So what's happening is they're either financing their dividends through their free cash flow, loans, or from the retained earnings that are on the books. So they're going deep into their pockets to be able to continue to pay that dividend. But judging by their profits per share being this hideous, my goodness, every 4 to 5 years, it's negative. And then as of the past 3 years, this is just atrocious right now. Like, what is going on, BP? This is pretty horrendous from a financial perspective. That dividend is not going to be sustainable. And the fact that the leadership team made that executive decision alongside with the board of directors, I don't know what they're drinking. I want some of it because how the heck are they thinking that the dividend is going to be affordable when it's clearly not? Speaking of which, if we take a look at their dividend history, yeah, during the pandemic, they cut it. The dividend got cut from 62 cents down to freaking 31 cents. So they cut it by 50%. And I think right now, it's about that time. It's been 5 years. They're probably going to cut that dividend again. Only time will tell. However, the dividend right now, it's growing by a rate of 4% year over year. It's going from $1.90 to $1.98. I don't know. So I guess I'll give them that. The dividend is growing, but when you lift open the engine hood and you take a look at what's going on, like if you're gonna buy a used car, don't just look at the exterior. You gotta look at the engine, the transmission. You gotta look at under the car to see if there's rust damage under there. And that's what I'm seeing. I'm like, I don't care that you got the headlights replaced. What I care about is that the freaking transmission is about to blow. Because your financials are just trash, my friend. And I'm so sorry if you're invested into BP. Maybe there's something going for them that I'm not cognizant of. So please put me on. Make me aware. But let's move on to the next company before I get too controversial. And that next company is Simon Property Group, ticker symbol SPG. And this is the third REIT that we're talking about here today. And they basically own a real estate portfolio for all of the major malls based here in the US. Why did I say here? I live in Japan. But in the US, that's what they do. And if you stumble upon any random premium outlet mall that you see on road trips, like in the middle of nowhere on the highway, it's usually owned and operated by Simon Property Group. And I'm going to say this right now, they're one of the pound for pound highest quality REITs out there. Current dividend yield is 4.8%, and the dividend is growing by 4.8% as well. I see what you're doing there. That leadership team is being funny money. And the next stock that just increased their dividend is Clorox, ticker symbol CLX. It's a very solid CPG player, but to be quite frank with you, their numbers have been stagnant since the pandemic boom of disinfecting products. Do you remember back in 2020 and 2021? Everybody, including your ex-wife, you wanted to have some kind of disinfectant spray or hand sanitizer, at least in the car. Now, we're back to normal, business as usual. No one cares anymore. Here in Japan, they don't even cover their noses when they sneeze. They just go, achoo, and they spray their mist everywhere. So a part of me wishes that we could have kept that nature and that behavior and routine of being clean and sanitary towards others, but especially with ourselves. It's just now no one cares. Everyone just coughs, sneezes. I'm a germaphobe, can't you tell? But I digress, because they're currently trading for about $120 a share. They're 1 year low. They're bouncing around it right now as $117, which means their current price is only up by 2.5% from their 1 year low. Now, I tuned in to their past 3 earnings calls, and they have this weird strategy in place to turn around the business operations. It's known as Ignite, but to be honest with you, I think only time will tell whether or not they can execute it. However, their company history itself is pretty high quality. It's just the demand for disinfecting and sanitizing products, it's just not as urgent and a necessity like it was back in 2020 and 2021. So that's kind of what they're trying to navigate through right now. And by the way, I made a deep dive analysis video covering everything about Clorox. Give that video a watch if you want more elaborate thoughts. But anyways, despite everything, they're still growing their dividend by 1.6%. Kudos to them. And the next one that we're covering is the Reinsurance Group of America, ticker symbol RGA. Believe it or not, I'm not just trying to plug my own content, but it's to show you that I have so much high quality, good videos on this channel that most of you haven't watched. You should go and give it a watch. But anyways, they're featured in my insurance industry breakdown video. I cover all of the major insurance players, and they're in there. Anyways, they're currently $193 a share. Their 1 year low was $159, and their dividend yield is 1.9%. The growth rate of their dividend is 4.4%. Can we just round up and say 4.5%? So not bad. It's respectable. The next stock is going to be the American States Water Company, ticker symbol R. Yeah, like we used to say back in 2007, MySpace days. Do you remember that era when people used to go, "rawr"? Maybe you're too old, maybe you're too young. Whatever. I grew up in the 90s and the early 2000s. And it's a water utility company that services some of the US military bases, and there's a lot to like about them. They're featured in my water utility stocks video, and all I'm going to say is that as of right now, they're near their 1 year low. And what's crazy is that they're growing their dividend by 8.2%. The water stocks, I think people are sleeping on them. They're probably one of my more preferred and favorite stocks out here. If we just pull them up real quick, let's take a look at this. American States Water Company. And we scroll on down right here, take a look at their dividend growth visually depicted. This is a beautiful picture. Yes, it's every 90 days. It's not every week, okay? It's not every month, it's every quarter. Look at the growth of this, consistent, reliable. Even during the pandemic, they didn't cut their dividend. They didn't just keep it flat. They grew their dividend every single year like clockwork. This is a high quality compounder, which, heck, this video is reminding me that I need to revisit my investing thesis for them because I might buy some of them this week. But shame on me because I should keep that commentary for the end of the video when I give you my thoughts and opinions and picks, right? I shouldn't say stuff like that right now. We're only looking at the numbers, the high level. So, next one is Wells Fargo. Oh, there's my dogs barking. Shout out to them. Ticker symbol WFC, and they're one of the major banks that make money from lending money to others with a bag of money. That makes sense. And this is a company that has no shortage of scandals, setbacks, and litigation. I think if you do retail banking with Wells Fargo, you need to take a good hard look at yourself in the mirror and say, why am I still doing my banking relationship with Wells Fargo? Especially not too long ago, they used to open up fraudulent accounts in your name in order to make more money. But maybe my words are a little too harsh because even Warren Buffett daddy, he seemingly likes Wells Fargo. It's a part of the Berkshire Hathaway portfolio. I'll give them props where props is due. The dividend is growing by 12.5% year over year. That's pretty phenomenal. Out of this entire list, I would argue that's the highest one that we have seen here today. And it's because right now, the financial industry, they're booming because of the deregulation that's happening in their sector and space. So they're able to operate with less red tape, preventing them from doing business the way they want to maximize profits. And the next one is Mondelez International, ticker symbol MDLZ. It's the parent company of Nabisco. Dude, when we talk about Oreos, Chips Ahoy, Honey Maid, Newton Fig Bars, and more, this is such a high quality CPG, snacks, candy, and cookies manufacturer. I would even argue they're right up there with the Hershey company. And their sales as of right now are growing, but their profit margins are being squeezed because of the historically high prices of the cocoa beans, which is the key ingredient to make chocolate. However, what's interesting about them is not too long ago, they wanted to buy out and acquire the Hershey company, but Hershey was like, no. You need to give up more money, good sir. It's kind of like in football or soccer. If you want to buy someone, that transfer fee is negotiable. Like their market value could be like 50 million. And their agent will convince them, we will take nothing less than 70 million. And then as a result, the deal does not go through. And that's kind of what happened with Hershey and the Mondelez company. And if we take a look at their profile, a 3.1% dividend yield, it's pretty much in line with the rest of the food CPG stocks. I guess a little bit on the lower end, might be closer to like Hormel, but in comparison to like General Mills, Conagra Brands, or even Flowers Foods, it's really small. But 3%, I would argue, is still decent. Dividend growth rate is 6.3%. I think across the board, I like what I see with Mondelez. And the next one is Cintas, ticker symbol CTAS, and they're in the business of doing B2B for hand soaps, refilling them in the bathrooms of your corporate building or for retail shops. They also sell cleaning supplies like mops and rags, first aid equipment, and uniform sales. And as of right now, their business is crushing it. The only thing that's not crushing it is their uniform sales. So right now they're $215. Let's just walk on over, take a look at their financials. A company with a very boring business model, right? They're not doing anything AI. They're not even in the tech space. Dude, they sell janitorial equipment. But take a look at their top line growth. And that's why time and time again on this channel, I keep saying that you can find beautiful potential 10 baggers in any sector and industry. It does not have to just be tech. So 2016, they posted $4.7 billion, and now it's $10.3 billion. They effectively doubled their revenue in about a decade. That's pretty darn impressive. And if we take a look at their bottom line, I think it'll be just as beautiful. Yes, it's just as beautiful. I think 2017 was a fluke year. They probably had a one-time line expense or an accounting write-off. Something happened, fluke. But since 2017, it's just up and to the right, very predictable, and it's good. Take a look at their free cash flow. Take a look at this, jump on down right here. Right now, it's $1.7 billion of free cash flow. This is a pretty high quality company. And a huge shout out to them, because a lot of my military veteran friends, when they come out and they don't want to go to grad school, like business school or law school or med school, a lot of them seemingly go to Cintas or into an Amazon warehouse. So shout out to them for hiring the fellow veterans. Dividend profile, 36% payout ratio, absolutely sustainable. There's a lot to like about them. But what I really like is their dividend growth. My goodness gracious, $1.56 to $1.80. That's a growth of 15.3% year over year. Cintas. And the next company is Vistra, ticker symbol VST. They sell electricity and power, especially for the growing and huge demand from the AI data centers. And they're actually featured in my utility industry breakdown video. And I'm going to tell you this right now. If you don't know anything about Vistra, their CAGR is way better than your favorite stock. Case in point, if I just pull this up right here, they're verifying me that I'm not a bot. So let's see, VST, take a look at their adjusted stock price total return. I'm on a website called Finance Charts, by the way. Past 20 years, 1,300%. So your money would have 14x'd in 20 years with Vistra. This is the definition of a dividend compounder with cheese. And if we jump on back over here, take a look at their dividend profile. Yes, the dividend yield is very small. Nothing to write home about. It's just like Nvidia, Google, Meta. It's small, it's negligible, but it's still there. And because of that dividend payout, they get inclusion into a lot of these dividend ETFs, which I would argue further increased their market capitalization, because now it opens the doors for a lot more invitations to different ETFs, not just growth-oriented ones, but also the dividend-friendly ones. However, what I don't agree with is that their dividend growth rate is 2.9%. Reason being is that if we jump on over here and you take a look at their financials, right? Absolutely a monster of a company right now. They're on a roar. because the AI data center movement is not a joke. That's not speculation. It is happening. Their earnings per share is $6.37. Yes, they had some weird, inconsistent, cyclical years, but since their business model has been catering towards AI data centers, they're crushing it. $6.37 for the bottom line per share. Their dividend payout is 90 cents, right? Their payout ratio is so freaking low, so it kind of bugs me that they're only growing it by 3%, but I get it. It's because not even like 3 or 4 years ago, they used to be unprofitable. So now that they're seeing pots of gold at the end of the rainbow, I don't think they're being too greedy, and instead they're playing it safe and conservative. So I think it speaks volumes on the leadership team to take the path of the slow and steady, because they absolutely could increase their dividend by 50 or even 60%, but they choose to keep it slow and steady. The next one that we're talking about is Wingstop, ticker symbol WING. And they're in the business of selling chicken wings. It's kind of like B-Dubs, Buffalo Wild Wings. And their operations remind me of Domino's Pizza because it's very asset light and a franchise model, meaning their franchisees are the ones that are doing everything. And instead, Wingstop Corporate gets royalty checks and fees for advertising, using their name and trademark, and of course, marketing fees. They're not the ones that are running the show. The franchisees are the ones that are running it. And I'm gonna say this right now. If you bought into Wingstop at their dip, because right now they're $332, right? Past 1 year. If you bought them at their absolute lows back in April, you'd be up by 60%. You're probably a very happy camper, and I'm actually proud of you. That's a really good play. You get a 60% rate of return in a matter of like 4.5 months, dude, that's bonkers. And a chicken wing restaurant company having a dividend growth rate of 11.1%, you love to see it. That speaks volumes to how high quality their financials must be to be able to grow your dividend at a double-digit rate. I don't think you guys understand. An 11% increase in your dividend payout is effectively increasing the amount of money that's going into your pockets by 11%. So when you think about your end of the year job progress, sit down meeting with your supervisor or your manager, and he says, hey, Harry, we'll give you a 1% raise. You get on your knees and you start kissing his shoes and you're happy, right? Imagine getting an 11% pay raise at the end of the year. So that's what I see, and I'm like, dude, that's really impressive. And that's why I like dividend growth investing. It just makes too much sense. Your passive income is going to be growing constantly because high quality compounders increase their dividend payouts every year. And I'll go on the record by saying it right now. Pay raises at your job are not guaranteed, especially if you work in sales. It's really dependent on your commission and how hard you're willing to work. You might make less than you did last year. And if you work at a corporate salary job, you're lucky to see a low single digit number, right? Like a 2, 3, or 4% growth in your salary. With dividend growth investing, you could see a growth of at least 11.1%. All I'm trying to say, I rest my case. Next one is going to be Republic Services, ticker symbol RSG, and they're in the business of waste disposal and recycling. Super high quality. They're featured in my buy and hold stocks forever, an industry I clearly think highly of. And let's see what's going on here. Dividend yield, nothing to write home about, but their dividend growth rate is almost 8%. You'll love to see it. And the next one is Comfort Systems USA, ticker symbol FIX. They're featured in my HVAC industry breakdown video. Didn't I tell you? I know I don't have that many views or subscribers, but dude, I nearly covered almost every industry and sector out there. I digested, analyzed, and extrapolated what's important to figure out who's the best of the best in a specific industry. They're featured in the HVAC space. And if you're wondering why you should go and watch that video, dude, HVAC is a necessary ingredient to keeping the AI data centers cool so that they can operate. Because if they run too hot, then they can't keep their servers and their cloud network up and running. So that's where HVAC comes into play. Anyways, currently $689. I'm going to tell you this right now. This company is absolutely a dividend compounder with cheese. And their dividend growth rate is 66%. It is bananas. This is such a high quality company that no one talks about. And when you take a look at just their share price appreciation alone, for the past 5 years, 1,200%, meaning your money would have 13x'd in valuation from just their share price appreciation. If you bake in the dividends as well, that number goes up higher. Take a look at their dividend profile. Payout ratio is 8.7%. So even though the dividend is growing at an astronomical rate of 66%, it's still only 8.7% of their profits. Pretty crazy. Look at the dividend profile. This is really a beautiful picture to see. So don't take my word for it. Go and watch that HVAC industry breakdown video to see why I think so highly of this company. By the way, they don't manufacture and sell the physical HVAC products or equipment. Instead, they sell the services of installing it and maintaining it through their network of contractors. It's a very unique business model, but I like it. And then, of course, the last one is going to be Altria, ticker symbol MO. They do everything and anything to do with tobacco and nicotine products. This is a company where I bought into them like 2.5, maybe 2 years ago at their absolute bottom price of like 35 or 34 bucks a share. And as of right now, they're 67 bucks. So I'm a pretty happy camper. So not only is my portfolio valuation up by almost 100%, but the dividends paid out, I think my yield on cost was like 11 or 12% dividend yield. Right now it's a 6.2%, but I'm a pretty happy guy with Altria as an investment. Now, their products, I absolutely despise and hate what they do to people. But as an investment in my portfolio paying me rent money and dividends, pretty happy guy. And the growth rate of their dividends right now, just shy of 4%. Now, out of this entire list, I think there's a handful of companies that I wouldn't mind having a part of my portfolio, or they're already a part of my portfolio, such as Realty Income Corporation. They're in my portfolio. And then Altria, they're a part of my portfolio. But other than that, I would love to have Comfort Systems USA a part of my portfolio. But they're on my watch list because as of right now, I do think they're trading for a pretty premium. They're kind of expensive right now. And I think I might buy into them this week. The American States Water Utility Company and Republic Services. I think they're a little expensive right now, but I definitely think they're high quality. And you might be confused with why I put no way Jose for Wingstop, even though their financials look phenomenal. Dividend growth rate is 11%. And that's because, you see, I would give them a chance if I had tried their food before, but I haven't. Reason being is that I have this weird protein allergy where I can't have chicken meat. I can eat eggs, scrambled eggs, all day long. Sunny side up, sunny side down, doesn't matter. I can have eggs, but I can't eat chicken meat. So I don't know if the food is any good. And as a guy that invests into restaurant and food stocks, I like to have that firsthand experience of what it feels like in my mouth, that bite, that chew factor, but to not be able to test them out, I'm like, even though on paper and their numbers look solid, I know it's a petty reason, but that's why it's a no way Jose. And then of course, Wells Fargo, way too many scandals. And there's other players in the financial space that I would invest into over Wells Fargo. It's not like someone has a hammer to my head and says, you have to invest into Wells Fargo. I have choice. As an American, I love that there's freedom to do what I want. And I don't have to invest into Wells Fargo if I don't have to. Same with M&T Bank. There's other banks out there that are higher quality and are better. But what's interesting and is not a surprise is that those that have a higher current dividend yield have a slower and a smaller dividend growth rate. Like Clorox and Realty Income both have a bonkers dividend yield. Whereas on the other hand, if we think about Comfort Systems or Cintas, their dividend yields aren't the highest, but their dividend growth rates are absolutely bananas. So just something to take into consideration. So my question to you before I sign out of here, dude, I need to go lay down. This food coma is kicking my butt right now. My question to you is, are you invested into any of them? And if you're not, how do you feel about any one of the 16 stocks that we covered here today? I know it was a lot to take in, but I hope you got some value out of the video. And I highly, highly suggest that after this video, you don't go to a buffet and eat 7 plates like I did, but instead you go and give a chance to some of the industry breakdown videos that I talked about here today. Because when you look at a stock in isolation individually, they look good, right? But when you compare them against their peers and their rivals in the competition, then you truly see that they're nothing special. They actually pale in comparison. So it would behoove of you to watch the HVAC industry breakdown, the REIT industry breakdown, the water utility breakdown, the electric power utility breakdown. Watch any one of them. I guarantee you it is worth your time. I promise. High quality content. Maybe not the editing, maybe not the face, but the content, the material, and the numbers presented, high quality. Anyways, I love you guys. This is not financial advice. Good luck in the stock market. Stay safe out here, and I'll talk to you really soon. Peace.